in a perfect world, everything works out for everybody, but we know that's not reality. And so we need to hold our cards tight to the vest. China does, in my opinion, economically needs us more than we need them.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. David, we're going to get to all these items in our agenda today, but I just first want to note, we have some more. I can hardly keep up. We're hiring so many people these days. We got a bunch in the studio with us today. With each wave of these young people who come in, I feel even older, but that's progress, I guess, for Retire Smart.
I don't know. I get a text message from our director of finance when I have to hit submit on each payroll, and the number gets a little more
I imagine
depressing every time. I'm like, what?
Well, we're well north of 40 people now.
Yeah.
Riley is training to be a new financial advisor, and she mentioned that watching our YouTube channel was part of what sparked her interest in Retire Smart. That's good news. As I've mentioned before, there's a reason I've done radio instead of television over the years. So the cameras, I'm still a little uncomfortable with
now
those.
That she's actually fully on board, wait till she gets access to the blooper reel and some of your legendary comments that have not gone out on the airwaves.
Look at the clock. We better keep moving here. All right. Hey, the third annual Teammates Golf Tournament fundraising for the Tom and Nancy Osborne Teammates Mentoring Program was June 12th. We are now the lead sponsor for that event. You played. We had 3 foursomes. How was it?
A lot of fun. The weather was a lot better this year than last. It was a little hotter last year, so bearable this year. So anyway, we got some pretty good golfers in our team, and we got a few folks that just went out and had some fun.
Okay, saw the whole course.
Yeah,
a lot of
value
shots.
Per stroke, as they call it, right?
Yeah. Okay. Well, good. Well, great event. Great cause, of course, Teammates, and we're happy to be the lead sponsor now for the Teammates Golf Tournament every year. The College World Series comes to town, starts this weekend, David. Any favorites in the field for you? There are a few Cinderella possibilities, Coastal Carolina and Murray State, and then you've got some heavyweights, Arizona, Oregon State, Louisville, UCLA, Arkansas, and an Omaha fan favorite, LSU, is coming this year.
Yeah, LSU always does well with the Jell-O shots, we know, and the donations go up at the bar that does that. But I got to pull for the underdog. So Murray and Coastal Carolina will be the two that I'll probably be pulling for. Well, so I love a good underdog story.
We'll see if one of them captures the home crowd this year. All right, into the news we go, David. Right before we sat down to record this show, you sent the team a statement, a social media statement from President Trump. Let me read the statement and let's get your take on it. So the statement is, our deal with China is done, subject to final approval with President Xi and me. Full magnets and any necessary rare earths will be supplied up front by China. Likewise, we will provide to China what was agreed to, including Chinese students using our colleges and universities, which has always been good with me. We are getting a total of 55% tariffs. China is getting 10%. Relationship is excellent. Thank you for your attention to this matter. David, your take.
So the markets liked the news when the tweet came out, at least the pre-markets as of Wednesday morning, and then the markets, were up a little bit, but they're not like ripping up 1,000 points. So, and I had sent a comment out when I put that into our internal message to the team that the markets are going to want real details really fast, or the markets may start to fade, because no longer can you get the market to move 1,000 points on the idea of a deal. They want to know the framework, and this gives you a slight bit of the framework, but it's still not an actual deal, subject to approval by me and Xi. So he's left himself room to back out, and of course, we haven't had any official statement from the Chinese delegation or, of course, the president himself. So we'll wait and see, but at least it's moving in the right direction. What I would like them to do is reconcile, okay, if we're going to charge them, say, 55% tariffs, and they're going to charge us 10, what is the net benefit to our economy? $10 billion a month in new revenue, whatever it is. If that's $120 billion a year, now let's run back to the House and say, all right, knock $120 billion out of the lowest income people, those under $100,000, which was the goal, right, to charge them nothing potentially in taxes. So move those savings over and show the American taxpayer that, okay, the whole reason for this is so you can pay less out of your wallet to the tax man. And you may pay a few dollars more for the products you buy, but you'll net win out in the end, right? Show us the numbers.
All right. You're not really going to be satisfied with this until you can see the direct application of what the results are.
No, because we cannot keep spending, and I'm all for keeping the tax rates, and they want, extending what we call the tax cuts. Well, they're the rates, right? And so it is a little bit unfair scoring by the CBO. If we leave tax rates the same, they're saying that he's raising, the deficit. Well, the deficit's projected to do that anyway. So let's get back to a balanced budget. Let's get serious. And I like that we have now 4 senators in the Senate pushing back hard. Hey, you're going to have to cut some serious money. So I think we're a long way from home, but we shall see.
Speaking of back here at home, we got the May job number recently, David. Here's a CNBC headline. U.S. payrolls increased 139,000 in May, more than expected. Unemployment at 4.2%. I want to combine that. I want to pair that with this next headline, David. Fed, this is from Reuters, by the way, Fed likely to leave rates unchanged as U.S. job market cools but doesn't crumble. So the consensus to the May job number seems to be kind of meh. We had some pretty robust March and April reports, but May seems to be leaving people, I don't know, kind of stuck in neutral. How do you see it?
Well, you have to go under the hood to look at these numbers.
All right.
Just as we did with the last administration, we got to do it with this one. So we actually lost 639,000 jobs. There's 630,000 less people working than there were a month ago. So they said we gained 139,000 jobs, but the unemployment rate was 4.1, Chip. You said it was now 4.2. It actually went up, and we have less people in the labor force. But that's less people actually working, doing productive things, paying taxes, spending money in our economy, and the job market is softening aggressively. Google just announced another round of cuts, a large employer. So we're going to continue to see this, and inflation, we just got out the CPI on Wednesday morning. It was better than expected, lower than most people, and I told you it would be last month, right? Now I think you're going to start to see that finally go the other way. Inflation will start to tick back up in the summer months. But the problem is, if the job market starts to fade, the Fed is going to be caught behind the 8 ball, so to speak. They keep saying, hey, we don't want to lower rates. Well, the European Union just cut for the 10th time last week, right? So they've made 10 cuts since the Fed's done anything. So the world is saying we got to lower interest rates because of the crazy amount of debt everyone is floating out there, and we have to now float because of the interest payments on our debt. Now it's $10.8 trillion we have to float this year. $10.8 trillion in new issuance has to come to the table, and if we're doing it at 4 to 4.5%, that's disaster. That's another $300 billion in interest payments alone per year.
Well, let's go there, because in the Reuters story, it quotes President Trump. He says, go for a full point. So he's talking about 100 basis points. Go for a full point. Rocket fuel. If inflation reignites, raise rates. What do you think of that?
I will tell you, if the Fed did that, that would be seen as a panic move, and you'd see a really ugly sell-off in the markets. I mean, very ugly. What we just saw in February would look like child's play, because that would be forecast into the markets. We're behind the 8 ball, even though I think they are behind the 8 ball. They can't, they have to message everything. It's how is the message received? Interest rates are going to be 100 basis points lower by Christmas, I believe. Now, when do they do it? That's the question. And typically, they're not going to do 100 basis points at a time unless we're in an all-out catastrophe. And that's what happened during COVID, happened during the great financial crisis of 08, 09, right? But if they're signaling that, then they're telling you it's really ugly what they see. And that's just it. They're not transparent with what they see. They're trying to thread a needle. And it's like Powell's got pride on his chest. Well, I'm not cutting rates just because. Well, you said if you got inflation near it, so why did you cut 50 basis points last September when inflation was still above 3%? Oh, we're making great progress. Well, if it's at 2.1 as it's reading now, then can't you cut further? So again, they make no sense with their statements, but it's going to be bad news near term. Keep your eye on yields on the bond market. I've been talking about it for a while. It's much more important right now to pay attention than the stock market.
David, I'm going to alert our producer, Shannon. I'm going to jump to the story that you referenced just a moment ago. It's a CNBC headline. Google offers buyouts to employees across the company, including search. What is it exactly that's happening at Google?
So the advancement of these AI platforms, the LLM platforms, learned language models, so ChatGPT, Grok, et cetera, all these models are replacing at a ridiculous speed search. Google last month, for the first time in their history, Chip, reported a decline in search volume. Wikipedia just this week got overtaken by ChatGPT. Just one of those such models gets more traffic now per day than Wikipedia, which is one of the most popular websites in history. So we're seeing a vast changing of the guard, and it's happening so fast, even these tech companies that are involved and invest in it are not keeping up. So Google, they make all the revenue from search, right? When you go search, I mean, it's a verb now, right? What did you do? I Googled it. And you might go DuckDuckGo or another browser to look for it. So it is really, it could be doom and gloom for Google if they don't adapt fast enough, because all that search revenue, ads, we spend money on ads digitally. When you click or you get an impression, if they put the ad in front of you, a company's paying for that. Well, if you're not on there searching, then that ad revenue is going to drop like a rock. So they're quickly having to figure this out, and more to come. And if you're using these products, you'll notice if you have a Gmail account, they're blasting Gemini, which is Google's version of AI, in your email. Hey, try this for free. And then they'll get you hooked on it. And then, oh, it's only $25 a month, right? So they're going to be shifting from an ad model to a subscription model, and they're having to accelerate it before they lose their revenue.
Up next, digital currency, cryptocurrency. It's not going away. You need to be informed about it. Stay tuned for the latest news in digital assets from Retire Smart financial advisor Brad Starken. He joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. As part of our continuing effort to inform and educate our clients and the general public on all manner of topics related to retirement, we bring you another conversation with our resident authority on digital assets. David, please welcome financial advisor Brad Starken.
Hey, thank you, Chip. Yeah, in the studio joining me now is Brad Starken, our resident authority on all things crypto and digital assets. How we doing?
Doing great. Thank you for having me.
Man, glad to get you back in here. So we've had some big news. The Coinbase, which is something we've talked about, is the most, I guess, reputable exchange still out there where people are buying and selling these digital assets. But that actually got added as a publicly traded company to the S&P 500. That's a pretty darn big deal.
Yeah, big news there. That actually happened on May 19th of this year. That's the first of its kind in the space to join the S&P 500.
But I think you told me before we started, it's basically the stock is literally just flat for the year. Is that right?
Yeah. So year to date, pretty much flat, maybe up just a percent or so, but just in the last month, up about 25%. So certainly when you get added,
hit pretty hard, but obviously getting added was pretty big news. And just to understand, when a stock gets added to the S&P 500, all those index funds, mutual funds that track it, have to buy the stock. So that usually gives a pretty good lift. So
that's right.
All right. So that's some pretty big news. We also have some news on the front of stablecoins, right, are coming to the forefront of the news. So you can kind of explain what a stablecoin is. Basically, it's almost like a money market, what it would be for cash, right? It's just you're parking in and locking in a dollars for a dollar value. Is that right? Stable?
Yeah. So typically it's going to be backed by some sort of currency, like the USDC right now. It's a 1-for-1 back of a US dollar on the backside. But the way you're able to transact that is what's really interesting, with being able to move money across, borders internationally, things like that, at literally pennies on the dollar, which is way more efficient
and
than our
lightning
Swift system.
Fast. Like
Yes.
if you wire over $1 million, you have to go through all the anti-money laundering training we have to do, right?
Yep.
So, but now you'll be able to do cross-border transactions instantaneously. And for, I think it's the founder of Stripe, who's from Ireland, a pretty smart tech guy, he talked about it. I think it'll cut the expense by 50 times.
Yeah.
So from 3% to a fraction of a percent.
Yeah, it's just making everything so much more efficient, so much more quick. It's very interesting technology for sure.
So you're telling me I'll be able to transfer money, as I just did before we started this segment, to my son, even quicker and less expense. That's fantastic. All right, so let's just talk about how Main Street people can learn about cryptocurrencies, digital assets. If they've never heard anything before, you teach a class, right?
Yes.
And we've got one of those coming up.
We do. So that class is going to be on Tuesday, June 24th at 6:30 p.m. here at our office in the Midwest Learning Center. But ultimately, you can go do your own research on the internet, online. It's ever changing. It's a very, very rapid changing class that we're putting together. I would say most of the information that I covered last year actually had to take about half that out of our presentation because it's just simply not relevant anymore.
It's moving fast. Obviously, this newer administration, the Trump administration, is very pro crypto, I would say, compared to the last one, right? And
definitely.
Not only that, you have the blessings from the SEC. So, the SEC, we were talking about the stablecoins a minute ago. It was called Ripple, XRP. That was a lawsuit for many, many years where it was just, hey, look, we're just valuing something against the U.S. dollar. What's the problem? And the SEC, the former chair, went against them. the SEC lost, and stablecoins prevailed. So now you have a pro-crypto person heading both the SEC and the Trump administration. David Sachs, who's the crypto czar, who's of the All In podcast fame, a self-made billionaire. He's the crypto czar, and he's pushing hard to get this to become mainstream. So how do we help our clients get exposure to these things? So we're not buying the actual cryptocurrency, but we do have exposure now for our clients.
Yes. So that would be inside of an ETF or an exchange traded fund. There's a handful of different companies that have those approved. Right now, there's only 2 approved for Bitcoin and Ethereum for the digital assets that are out there, the cryptocurrencies. And that's that's a pretty easy way to get exposure. Other companies will actually custody your assets for you, versus if we talk about this in the class, where if you were actually to go out and buy it yourself on Coinbase, if there's no such thing as, forgot your password on some of these keys and things like that, and then you're putting yourself at risk for either hacks, or if you take that offline, if you lose something, if you lose your basically your hard drive.
We have a member of our crew here that bought 4 Bitcoins when they first got married, her and her spouse, and they can't get to them. And boy, they wish they could. Their house would be paid for, their kids' college would be paid for, because I think they bought them for $200. And what's Bitcoin up to? It's hit a record high since you were last year.
Yeah, since on the last show, it did hit a record high about a month ago, about 110,000, and we're approaching that again here right now. So a very volatile space. I think it's very interesting. I would say also one of the interesting things is what everyone continues to call for in this space is they actually want more regulation. Typically, a lot of industries say they want less regulation, but just because this is in its infancy still of only really being around for 14, 15 years, there needs to be more regulation for this to continue to move forward.
And we don't want overreach, but I'm one of those that called for regulation. We just want to know the rules, right?
Exactly.
Because it was so confusing between what the IRS said, the SEC said, and then the Department of Labor, et cetera, on transacting in these currencies, which if you can call them a currency, I always joke, if something can move 40% in value from the time you leave your house to the car dealership, I don't really think that's a stable currency. But it is becoming so much more mainstream, so much more viable. In fact, Ethereum is the one that I had the biggest investment personally in, and I got rid of most of mine at the start of the year based on the valuations and pushing it into a new tax year. But that one's had a lot of volume here as of late, right?
Yes. So certainly, once again, that one's down year to date. It's been very volatile, but actually over the last 7 weeks, we've had 7 straight weeks of inflows into the Ethereum ETFs as a whole. Last week, over $281 million just adding into those ETFs for Ethereum as a whole.
Now, we don't have a lot of time to get into it today, but Ethereum is one of the prominent ones where what we call smart contracts will transfer, right? So we can transfer value. So supply chain management will get disrupted, accounting as the price. If I bought this mug from China, everywhere it went, the monetary value of it changes with it using smart contracts, right? So that's why this stuff is so prevalent, where Bitcoin is not typically used in those things. That's more of a store of value. That's more of the digital gold, if you will, right?
That's right. So there'd be some higher transaction costs within Bitcoin if you were to send money along the way. And I guess my bad joke is, if we're going to the gas station, you're not shaving off pieces of gold to get gas, right? That's just not feasible. That's not how we transact money. More than likely, Bitcoin is not going to be the way of actually day-to-day transactions. I believe some of these others that are coming up have that ability to do that.
Very good. So lots to come, lots more to find out from the government on how they transact this, but it's definitely something you should be paying attention because digital assets are here to stay. Now, I would caution anyone, we're not making any recommendations when we talk about specific cryptocurrencies, et cetera. We don't actually purchase these on behalf of our clients. Both Brad and I are personally invested in some of these things at our own risk tolerance, if you will.
Yes.
But it's not for the faint of heart. You need to understand it before you go hog wild. But we do have very, very small exposure using high quality exchange traded funds from companies like Fidelity on the top ones. Now, the newest exchange traded fund to launch. Let's talk about that. What is that?
Yes, so that would be XRP or Ripple that you were just mentioning about. That there's some people or some ETFs in the works that are actually getting reviewed right now to see if that'll be the next one to launch. So right now it's just Bitcoin and Ethereum are the ETFs that are available to the public. That one's in process with Wisdom Tree right now and actually getting reviewed. Maybe that gets approved, maybe not. But typically, someone will rework the language, and at some point, once one gets one through, then all the other companies follow suit.
Well, and these bigger companies, when they're putting out these ETFs, they are acquiring the cryptocurrency. So some ETFs, and I guess I would just say word of caution if you're trying to even buy one of these ETFs on your own, which would sometimes seem more safe than even buying the cryptocurrencies. Are they tracking the price of it, or do they own the underlying asset? Right,
Exactly.
the big distinctions. Can you talk about that?
Yeah, so each ETF that's out there is going to be a little bit different. So Fidelity's typically the one that we're gravitating towards. They actually been mining Bitcoin. Fidelity as a company since 2014. They understand.
I was in their
custody.
headquarters in Boston. I guess it's been a year and a half, and
Yeah.
literally they showed us the original mining machines they'd built, and it's kind of wild. And they have them in these glass bubbles, but they even look archaic compared to the computers that they showed us the server farm they've built to do it today. They're serious about it.
Yeah. So just with that experience and them understanding all the different layers of that and being in that space themselves for 10, 11 years, that's why we like trusting them versus some of the other companies out there like BlackRock are technically not custodying theirs. It could be relying on Coinbase and others. So, just from a security standpoint, we're doing a lot of research on the back end for all of our clients for sure.
So if you want to learn about cryptocurrency, how the values on these things may move up or down, why they'll do that, and the usefulness of their technology, most commonly called blockchain technology, and how valuable it is, you really want to attend this class. So when is this class again?
Yes, so that'll be Tuesday, June 24th, 6:30 p.m. at our Midwest Learning Center.
All right, but you do need to register. You can call the office or go to the events page at retiresmartnow.com. Brad, we are out of time. Thank you so much for stopping in.
Thank you.
All right, Chip, what do we have next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go, David. First question is about a 401k. Actually, it's also about a mortgage. I'm 62 and plan to retire in 3 years. I still owe $20,000 on my mortgage. The idea of retiring debt-free with the house paid off is tempting. Should I use money from my 401k to pay off the mortgage?
Okay, there's a lot to unpack there, and the answer is probably not. I don't have all the information, so I can't give you a certain answer, and you're not our client. But
Well, you need to know the interest rate of the mortgage for one thing.
well,
don't
so
you?
exactly. So what is the interest rate on the mortgage? And assuming the 401k is the traditional 401k, when you take that money out, it's going to be taxed as income. And if you're working today, and by the way, most 401k plans, about 96% of them allow, once you attain what's called a qualified age, 59 and a half, which this person is 62, so they've done it. Most 401ks allow you to do what's called an in-service withdrawal. In other words, you can withdraw some of your balance without any penalties, but it's still a taxable event. So you could take this money out to pay the debt off. The problem is you're going to pay income tax. And let's just give the benefit of the doubt that you're in the most common lower tax bracket, 12%, plus another 5.5% basically to the state of Nebraska. So you have about an 18% tax bill there, and it could be significantly higher if you have a higher income. It could be 24%, and so it could be 30% if you're in the next tax bracket up. So benefit out, let's say you could do it at 18%. Well, that means you're going to have to pull out $3,600 more than the amount you need to pay off, right, to be able to cover
pay the tax.
the taxes on that withdrawal. So you're giving up money where you're only paying interest, and over half of all mortgages in the country today, Chip, are below 3.5%. And assuming this mortgage has been in place for a while, I'm going to assume it's probably a lower rate. Again, I don't know this to be sure. You can still write off that interest on the mortgage. So I would be inclined to tell you not to potentially do that, and then wait until you retire, and then just continue to pay it off, because you're probably going to have better time value of money. In other words, that money's probably out earning what the interest rate you're paying on the $20,000.
If it's at 3 or 3.5% interest, but your money can earn you 6 or 7% interest.
Well, you can earn 7, 8, or 9 in the market long term, of course, but you can earn 4 or 5 guaranteed right now. So, I mean, there's an arbitrage in your favor. I would try to take advantage of that.
Next question, David. This is about Medicare and IRMAA, the income-related monthly adjustment amount. I missed your recent class on IRMAA. I'll try to make the next one, but in the meantime, could you give a quick review of what the IRMAA penalty is and how proper planning can help me avoid it?
So this was enacted in 2004 under the younger George Bush. Basically, what it did is we added Medicare Part D. So that's when we came out with the prescription drug program for Medicare. And so Part B is the Medicare program that you pay monthly for. So if you don't know, once you turn 65 and sign up for Medicare, you actually have to pay for it, right? And so for most Americans, it's $180 a month this year. However, if you make too much income, and it's a 2-year look back, so this is where a lot of people get caught. So in other words, what income you earned at 63 is going to set your Medicare premium at 65. So that $180 I told you it was this year, well, just 4 years ago, Chip, that was only $130. Right? So the inflation, they keep pushing this number up fast at about 6% a year. So you have to pay to access Medicare. Now, what happens, Chip, is if you have too much household income, in other words, too much monthly income by definition of the government, and today for a single taxpayer, that's $103,000 in income. So if you earn over that, and double it if you're married, so $206 if you're married, you now have to pay an $80 monthly penalty on top of the $180 to pay to access Medicare. That's the IRMAA penalty. But that's just the first penalty line. There are 5 such penalty lines. And if you're married and you have a large IRA, you saved up, say you got $1 million in your 401k that rolls to an IRA, and you keep deferring it because we were all told, hey, defer, defer, defer. Is that a good deal? Probably not, because you're not only going to pay income tax when you take that out, but now that may push you over that income threshold we just talked about, causing not only you, but your spouse to pay. There's a penalty for B, Medicare Part B, and for Part D. And if you're married, there's 4. So you're both spouses.
Those withdrawals count as income.
Yeah.
So your income just keeps stacking up higher.
So you can end up paying well over $12,000 a year in additional, basically a tax penalty to access Medicare if you don't know how to control your income. So to get to the bottom line, what can you do to proactively plan for it is understand what type of income you're going to have in retirement. There are basically 2 types of income, and they're on 2 types of the tax fence. There's guaranteed income, non-guaranteed income. Guaranteed income for what we're talking about today would be a pension if you're blessed to have one, Social Security, railroad retirement. These are checks that you can reasonably rely on every single month. Then your non-guaranteed incomes, interest, dividends, portfolio withdrawals, etc. But if those are in tax-deferred accounts, those withdrawals are taxable, which creates taxation on the other income, the Social Security income, which if you didn't have it, confused, right? If you had only Roth distributions, so if you did Roth conversions, for instance, over a period of time before you got your income too high to hit the IRMAA penalty, Social Security 1, Social Security 2, and 2 Roth distributions, you would pay no IRMAA penalty no matter how large those distributions were because they do not qualify for IRMAA.
So my withdrawal from a Roth account, I'm not getting taxed
not
on that,
Medicare eligible.
and I don't have to count it as income.
Correct.
I'm figuring it, oh my
This
goodness.
is massive. Now, the Roth is just one example. There are multiple ways we can show you how to set yourself up for tax advantage or potentially tax-free income in retirement, but it doesn't happen overnight. You can't walk in and we just snap our fingers and, hey, you're tax-free. Wow. No, it takes planning, and the average client, 6 to 8 years of the tax planning. But, I mean, we regularly save people 6 figures in lifetime taxes, and IRMAA is part of those savings. But you got to act.
Goodness. Well, the takeaway is here, people think retirement planning, okay, and then it's all over when I retire. I just enjoy the money. No, there's so much action on the other side of your retirement to make sure things like this don't happen to you.
Absolutely. It's a
penalty.
lot to figure out.
Oh, my goodness. All right, David, let's hit one more question. This is about, getting a late start when it comes to retirement. My wife and I are late to the game in saving for retirement. We're in our late 50s, and between us have about $125,000 in several retirement accounts. Should we plan on working until we die, or is there a path to a decent retirement for us?
So there's always a path, and you should always start with 3 letters, NOW, now, right? And so get started, start planning. You're in your 50s. You may work longer than maybe originally intended, but we're living longer, we're healthier. A lot of Americans are going to work till they're 70. That's the reality today. So you've got, probably at least a decade or so, I don't know the exact numbers here, that you could continue to contribute. Now, the question is, are you living above your means or below your means? In other words, do you have discretionary income that you can start to accelerate saving and deferring money for your retirement? Because you're going to have, most likely, Social Security, 2 of them said they're married. So you'll have 2 checks coming in a month. What's the gap? That's the first thing you have to figure out is, how much income will that be? And you can go on SSA.gov and figure this out. Hey, what will my retirement income be at, say, 67 from Social Security? Do that for your spouse. Now you have 2 checks. So inflation adjusts today, Chip, I'd start off, hey, how much do I need to live? Let's just say they live on $5,000 a month, just picking a number. And Social Security between the 2 of them was going to be $4,200 a month in 10 years. Now inflation adjusts that $5,000. They might need about $7,500 when that gets here. And if they're going to have $4,200 a month, how much do they need? $3,000 a month. Well, if you need $3,000 a month, will 125 do it? No. right? So it's simple math, but you should work with a competent professional to help run these calculations to show you, hey, you need to start focusing on saving X amount, and if we get it to this number, then you can know when to retire. It's simple math. There's no guesswork here. You need to know how much income you have, how much income you're going to need, and what expenses will go away. For instance, if, like the previous questioner, if they didn't have the mortgage and you had an $800 a month mortgage and it's no longer there, well, then it's $800 less per month you may need. So there's a lot of factors. Great candidate for the report card, Chip.
Yeah, we look at your whole situation. Well, and the key takeaway here is, as you said, now, okay, don't lament the decades that you've lost. Get in the door to us or someone now and get some advice and get a plan in place. You can arrive at that day when you could retire, but you better start working it right now. All right. Up next, DOGE had a recent victory in the Supreme Court. Was it good news or bad news for retirees? We'll tell you about it next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David, I do want to get to that DOGE story in the Supreme Court, but first, you sent the team a chart about M2 money supply. In the first segment of the show, we were talking about, well, the Fed's nervous about reigniting inflation. Everybody's got an eye on inflation. Inflation, we usually worry about M2, which was the economic term for our money supply. We're worried about it expanding too much, too fast, too many dollars, chasing too few goods, and so forth. But you sent out a chart and shared your concern about a possible contraction in the money supply. What are you worried about?
So the money supply typically grows right around the inflation rate, 3.5% a year. And we've got data going way back. So there's going to be more dollars floating around, right? More money out in the economy. And that's good if it's in a controlled. But when we get these bazookas of money blasted out, as we did started way back in TARP in 2009 to save
Troubled
the economy.
Asset Relief
and then
Program.
quantitative easing, they started cranking out dollars. And of course, during COVID, $5.7 trillion.
Payments.
So and the chart shows you the explosion of the money supply. Well, that's what inflation is caused by. I often, sometimes I'll have like a bowl of 10 apples and explain how inflation really works. If $10 was all the currency in the world and 10 apples were the only products in the world, how much does an apple cost?
$1 an apple.
$1.
Yeah.
If I increase the money supply to $20, how much does the apple cost?
Cha-ching, now they're all $2 each.
It's more dollars chasing less goods. That's inflation, bar none. Now, what happens, though, is so we don't want money supply to continue growing rapidly. We want it to grow at a modest pace. But when money supply contracts, especially over short term or even cycles, 4 or 5 year cycles, money's being sucked out of the economy, liquidity's pulled away. That is not good for markets. And we have a rolling 4-year where we're in this cycle right now where money supply is starting to contract on a longer term basis. That creates some problems, and that could create some havoc coming down the road. So it is something I watch every week, how much money's actually in the economy. And just so you understand, M2 is cash, money markets, cash-like derivatives in all banks in America, et cetera, all the liquid capital that people have. This is not dollars invested in stocks, et cetera. And so that money supply is important to watch. And right now, there's over $7 trillion in these type of accounts. But the liquidity is drying up, especially at the larger commercial banks. And we've talked about this for many reasons. The commercial real estate is really imploding on these banks. They're having to sell properties at pennies on the dollar. They're trying to clear their balance sheet up. When they do that, they have to take some of their cash, the bank's cash, to pay off the debt they lost money. And then they're doing this quickly and quietly. But as we sit here today, there are over $600 billion in unrealized losses on the top 200 banks in America today. They're all insolvent. If you did any traditional accounting, like when I went to school, the banks are all insolvent. And so that is a concern. Like we talked about it a while back, the slow run on the banks last year, right? Is it happening?
Yeah.
I was like, yeah, it's happening. Well, if everybody went and withdrew their money today, I'm not saying go do this, but that would create some havoc. I mean, you can walk into a bank. My wife had to purchase something last year. I walked into a local bank and it was asking for $7,500 in cash, right? Not that exorbitant amount. They didn't have it. You have to come back Thursday. We don't keep that kind of cash in a bank.
Wow. Yeah.
That's pretty eye-opening, right? That these branches, some of them don't have $10,000 in the branch, right? So
we're back to the Bailey Savings and Loan during the Depression.
Your money, George, is in Barbara's house over there, right?
Yeah. Well, actually, taken to the extreme. I mean, that's what happened in the Great Depression, right? I mean, the economy lost something like a third of its capital. And we are a consumer-driven economy. We got to have capital sloshing around out there, people spending money.
And on the downside of it, the Fed is easing regulations on how much what we call Tier 1 capital these banks have to have on hand. But just so you know, it's single digits. Most of these banks have about 8 to 9 cents on the dollar. So when you deposit $100,000, maybe you buy a certificate of disappointment from the bank. Woohoo, I'm getting 4% interest. Oh, wait, inflation's 2.5%, and you get taxed on it. Oh, I didn't make any money. But anyway, a CD, certificate of deposit, the bank doesn't go throw that $100,000 in the vault and lock the door. They have to take that money and then lend it out or turn the dollars over the velocity of money to make money to be able to pay you said interest rate. And so they make what's called net margin spread. They if they're paying you 4%, they're going to charge somebody else 7 or 8, right, on a car loan, house loan, credit cards, whatever, and make the difference. So what happens is if you go to withdraw your money, well, they only have about 10 cents of that 100,000, on the dollar in the vault. So you can't get your $100,000 out. And so you might have to call, like I did, say, make an appointment to show back up 3 days later to get what I didn't think is an exorbitant amount of money out. But anyway, it's the crazy times. Pay attention. Don't get harmed.
David, I do want to get to this DOGE story now. Department of Government Efficiency. Now, here's the Market Watch headline. And I want to get your take because Market Watch seems to be kind of casting a dark cloud over this. So the headline is DOGE's expanded Social Security access raises fresh privacy fears. The stakes are very high. So DOGE gets access to Social Security. DOGE, of course, is trying to root out fraud in government. But the concern here is private information, gender, immigration status, bank account numbers, medical data, that all of this could be at risk. Do you share MarketWatch's concern about this victory for DOGE in the Supreme Court?
Not at all. I'm happy for the victory. So imagine you're trying to run a company and you hire somebody to audit your books. Hey, listen, I want you to go to audit Chip. He's in my marketing department. Audit where they're spending money on our radio ads. And you're like, well, I'm not going to show you. I'm just spending this much. You can't see where, who, how much, which ad I placed where, right?
Doesn't sound like much of an audit.
Well, and I don't think you'd have a job very long, right? But that's what we have going on at the federal government. These are government employees. They are officially signed on as government employees. They have clearance, security clearance. They've been vetted, and they're simply trying to look at the data to see if we can become more efficient, which I think all Americans want. There was a pretty big mandate at the election, and it's not political. It's like, hey, we don't want waste and frauds. You mentioned fraud. It's the waste I'm more concerned with. Okay. We had Social Security checks going out to people that were no longer alive. They've corrected some of that. And they're just trying to figure out where the flaws are in the system. I mean, we want the system to last, right? Well, you'd want to make sure you have an accounting of it. And I don't think that's unreasonable. We talked about on the show, when you retire, and we do a lot of federal benefit employees here, Chip, when you retire from the federal government in Iron Mountain, Pennsylvania, literally somebody gets on a bicycle and bikes into the mountain and goes into a treasure trove of files that are in these old Filofax files to pull your file. And it took on average 2 to 4 months to process somebody's retirement. That has all been digitized with DOGE, and they've literally just launched within the last 10 days a new digital form of retirement. Somebody can be retired now in 3 days from the federal government. That's efficiency.
Yeah.
Right? And imagine if we did that to all departments of the government. And why is anybody pushing back on this? Oh, would somebody maybe have some fingers in the cookie jar? I don't know.
Say it ain't so. Well, we'll keep an eye on how that plays out. Fox Business headline, David. Expert reveals America's secret weapon against long-term competition with China. This is Michael Pillsbury, speaking on Varney and Company on the Fox network, and he is worried about China's leverage with us regarding rare earths. In fact, that was mentioned in the president's statement, but says we have a secret weapon. What's the secret weapon?
Well, there are other places you can get rare earth minerals, which is why Trump is so...
Ukraine comes to mind.
Yeah,
we just did a deal with Ukraine.
Greenland, Iceland, and actually in Canada. And so we have several neighbors that we used to be friendly with, if you will, but that have the opportunity to mine these. And then here in the U.S., there's several deposits in a few key states. So understanding rare earth minerals are certain minerals that are really needed for high-end manufacturing because you can use them. They can take heat, so they worked in processors. A lot of the chips and the technology, your phone, your iPhone or Samsung or whatever you have. has a ton of rare earths in it, and China is the most active miner of such minerals in the globe. And right now, they're about 90% of all sold rare earth minerals, but they don't control 90% of the supply. They do control a large quantity of it. But until we get manufacturing in these other locations and trade deals up where we can confidently know we're going to have the inflow we need of these particular minerals, et cetera, China's a key ingredient for us. So that's their bargaining chip to us. However, again, the secret weapon is we talk about 1,800 factories closed in 30 days. They had unrest, and China's pretty good with their media, right? Communist state-controlled media, so you don't see it. But there are riots in the street. Speaking of riots, we haven't got to what happened in L.A. this week. But anyway, China has had that going on because people are starving there. When the Liberation Day went on, the tariffs were announced, all American companies stopped ordering product, right? And that hurt China desperately, which is why they came to the negotiating table and are at least looking to try and get something done. Again, in a perfect world, everything works out for everybody, but we know that's not reality. And so we need to hold our cards tight to the vest. China does, in my opinion, economically needs us more than we need them.
To that point, Pillsbury, who's with the Heritage Foundation, says the key for our side is unleashing our own economy. So we're never in a position of desperation.
Well,
when we're dealing with them.
We don't want to reshore, making T-shirts, right? That's just not productivity at the old textile mills that we had here in the U.S. But we do want to reshore certain jobs and our certain industries that are due to national security. And that would be the construction of ships, right? Our Navy, instead of contracting that out to European countries, and pharmaceuticals, right? 96% of all pharmaceuticals in the U.S., everybody that's dependent on taking these pills, come from China. That's kind of scary. But anyway, yeah, I will look forward to this getting settled soon, and maybe that helps the economy. But I would be very, very doubtful that we have a robust economy here in the fall. I just think job market's going to get really, really weak.
That'll do it for this week, folks. Please visit our website, retiresmartnow.com, and click Attend an Event at the top of the page to see everything we currently offer, including Brad Starken's Digital Assets Workshop. There's no charge, there's no obligation for our events, but you must register. You can do it online or by calling 402-369-7777. David, bring us home.
Hey, thanks for listening. Have a blessed and prosperous week. We'll talk to you next time.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week. Tom Osborne and teammates are not clients of Retire Smart and were compensated for this sponsorship endorsement as such term is defined under SEC Rule 206, subsection 4-1. For further information about this sponsorship and the compensation details, visit retiresmartnow.com and click on the Sponsorships tab.